So if I decide that I would like to participate in the good management of this insurance company, then I would do so by acquiring a participating whole life policy. Not all whole life insurers offer participating and non-participating policies. Some insurers only offer participating and some only offer non-participating. Some offer both options. So I decide, you know what, I'd like to acquire that participating whole life policy. Great. We would agree then that in a good year, the insurance company might have done a good job of keeping its expenses in check. And if they've done a good job of keeping their expenses in check, there's more money that's been paid into the insurance policy than is needed. And those participating policy owners will actually get some of that money back. I'll show you how in a minute. The insurance company might have had less claims experience than they expected. That is, they might have expected that they were going to lose, let's say, 5 policy owners this year, and they only lost 4 policy owners that year, or 4 life insurance, I should say. So if they lost less life insurance than expected, that means that there's more money here than we anticipated. We have a better mortality than expected. So if the mortality is better than expected, there's excess funds there. You, the participating policy owner, have paid too much premium. You're going to get some of that back. Also, the investments. Maybe the insurance company assumed that they needed a 4.5% rate of return on their investments in order to make this work, and they got a 4.75% rate of return on their investments. Well, now your investments have also done better than expected. And we're going to take some of that money and return it to those participating whole life policy owners. Now, it does beg a question, doesn't it? What if the expenses were greater than expected? What if the mortality was more than expected? What if the investments did worse than expected? Do our whole life policy owners have to put more money in? They do not. Whether we're talking about participating or non-participating policy owners, the insurance company takes on the risk that these things do worse than expected. You will not see your premiums increase in a guaranteed premium structure, which is most often what we'll see today with whole life insurance. If you have that guaranteed premium structure, that means that these factors will not change throughout the life of the policy for the worse. You won't have to put more money in. If you are a non-participating policy owner, then your initial premium would have been lower, but you will not enjoy the benefits of this overpayment of premiums on the occasion that it happens. If you are a participating policy owner, when these things happen, we're going to give you some of that money back. Now, there's no guarantee that this happens. These are all based on variable circumstances. There's no guarantee that you're going to get dividend payments back. In some cases, in the past, insurance companies have gotten themselves into trouble when they have made statements that indicated they were promising dividend payments. We cannot promise dividend payments. Although you'll find today that most insurance companies have a very good track record of paying out their dividends. You'll find most Canadian insurance companies have paid dividends in the last 100 or 140 years, in some cases right since the date of their existence. So those dividend scales have tended to stay where we expect them to stay. There is some risk, though. The insurance company can change their dividend scale. We saw a major Canadian insurer reduce their dividend scale a couple of years ago. They're still paying dividends, but they're not paying the dividends that the policy owners necessarily anticipated. However, those policy owners should not have been promised their dividend. We knew it was not going to be guaranteed. So now let's have a look at what happens to that dividend. Now, to be perfectly clear, the dividend that we're referring to here with a participating whole life policy is a policy dividend. It is not a stock dividend. You'll recall that you had a discussion around stock dividends back in Module 6. And those stock dividends came about as a result of profits of a corporation, and the corporation decided they were going to pay some of that profit, or more accurately, earnings, out to their shareholders. Well, this is not exactly the same thing. This dividend is a policy dividend paid out to the participating whole life policy owners in exchange for their having paid too much premium. It's not subject to the gross up, for example, that you saw back in Module 5. It's not subject to dividend gross up. It's not subject to the dividend tax credits. It can be a taxable event in a sense, but it generally doesn't create taxable income for the policy owner. We'll learn more about that when we look at taxation of life insurance a little bit later on in this module. So what do we do with these dividends? Well, there are 7 dividend options available. Not all insurance companies offer the 7 dividends. In fact, not even all insurance companies offer participating whole life insurance. But if you do have a dividend, what are you going to do with it? Well, there are really 7 different things we can do with it. Sometimes we just give it back to the policy owner as cash or check. They just get the money back. Easy. Sometimes we leave it as a pool of savings. This is referred to in industry literature typically as dividends on deposit or dividends left on deposit. And those dividends on deposit, it's really like having a savings account attached to your whole life policy. Something to be wary of here, though, is that this is not a tax-exempt situation. You've taken those dividends, you've invested them outside of the policy. This is taxable. Any growth that happens here will result in a T5 being issued and taxes being paid, just like on a regular savings account at your bank. The other option we have, we can take that money and put it into an IVIC, an individual variable insurance contract. The IVIC or the segregated fund, and you'll learn about the IVIC or segregated fund a little bit later in this course. It's going to have some similar characteristics to that dividends on deposit. It's really an extra pool of investment now that we have associated with our whole life policy, but it's going to generate tax consequences just the same as a regular investment would.